Good morning and afternoon, everyone. Welcome to our webinar, the Final Tangible Property Repair Regulations and Fixed Asset Review, Opportunities for 2016 and Beyond. Now, just a little bit about our company. KBKG was established in 1999. We have offices across the U.S., including Illinois, Pennsylvania, Arizona, Ohio, where our presenter John is located, New York, Texas, and Pasadena, California, where I am located. We provide turnkey tax solutions to CPAs and businesses. Our engineers and tax experts have performed thousands of tax projects, resulting in hundreds of millions of dollars in benefits for our clients. Our team is a diverse mix of tax specialists, attorneys, and engineers from various disciplines. This combination of talent allows us to be the best at what we do and maximize results for our clients. KBKG is a preferred provider for thousands of CPAs across the country. And now I'm going to turn it over to our presenter, John, so he can tell you a little bit about himself.
Thanks so much, Allison. Yes, good to be here today. Real quick, just explain who I am. I'm a director here at KBKG in the Fixed Assets and Cost Segregation practice. I'm also a member of the Accounting Methods and Credit Services group, which basically we're specializing in completing all of the change forms, 3115s, as it relates to fixed assets repairs, or maybe if you're just doing a look-back study on a cost segregation. A couple of degrees here, Ohio schools being a theme, Ohio Wesleyan and Ohio University, where I got my MBA. I hold my LEED Green Associate Credential, and then finally I am a certified member of ASCSP, which is American Society of Cost Segregation Professionals. So we're going to talk about what I'll refer to as the old tangible property regs, not the new tangible property regs they released back in 2013. So this is something that many people obviously know about and certainly have had to conform to this point. But in an effort to freshen it up, I did want to talk about some recent developments, some of which include and were released in the PATH Act, which is protecting Americans against tax hikes. In 2015, retroactively reinstated some of the tax extenders, most notably for our purposes and kind of what we're talking about today is 50% bonus depreciation, and then it actually phases down. It's 40% in 2018 and finally 30% in 2019. That's kind of a welcome change, because we'd always wait to the end of the year to see if bonus was going to come back or bonus was extended. So at least we can do a little bit of planning now and have those systems developed at the beginning of the year to understand how much bonus we really are going to get. Section 179 increased expensing amounts for small businesses, which have now been made permanent at the $500,000 level. So just there's a dollar for dollar phase out. So at $2 million and above. So $2.5 million, you're totally phased out of that. But again, kind of a nice welcome change that those now have been made permanent. Other opportunities under the PATH Act is qualified improvement property. Now, you all may be very familiar with qualified leasehold improvement property. This is different, and I'll explain how. So qualified improvement property sets forth criteria making it available for a broader set of taxpayers than the old qualified leasehold improvement property. And the reason for that, most notably, is that they removed a couple of qualifications. There's no 3-year rule and then no lease requirement. So those were the big things that kind of kicked some landlords out of qualified leasehold improvement property. Maybe it was a new property that they were just doing the fit outs, and maybe they were even doing fit outs for their own businesses. They would obviously been kicked out of qualified leasehold improvement property, but qualified improvement property, they will get that treatment. Now, it's qualified improvement property is recovered over 39 years, but still gets bonus, and it's eligible for bonus. So over the next several years, when we still have 50, 40, or 30% bonus, that's going to be significant. Even though it's long life property, you still will see it getting bonus. Just a heads up there, obviously bonus is an allowable deduction in the first year for short life property, which is defined as anything 20 years or less. So you will see on the depreciation schedules 39-year long life property getting bonus treatment. So it probably relates to qualified improvement property. Other tax planning strategies under the PATH Act. You may all know now that R&D tax credit has been made permanent for about 15 to 16 years. Those experts in that field waited until the end of the year to see if that was going to get extended every single year, waiting around to see if they were going to have a job as a specialist. Now they have a little bit more comfort, and now it's becoming much more popular that it is permanent. So R&D tax credits, we assume is going to have a huge uptick in our business line, just because of it being thrust to the front of everybody's mind. Section 179D, energy efficient deductions was extended for 2016 for commercial buildings, and then 45L was also extended through 2016, and that is a credit for multifamily or residential units. So the 179D being $1.80 per square foot deduction for commercial buildings, of course. And what we're talking about is if they're building or doing anything that is energy efficient, you might want to take a look at this. Also for the 45L, if you've got a home builder or a development company that's putting in multifamily units, those add up pretty quickly, and that is a credit. So you might want to take a look at that. There are some qualifiers for the 45L. It's got to be a low-rise apartment, garden style, 3 years or 3 stories or less. Another great thing that came out was the release of the retail restaurant industry safe harbor. So let me take a step back. What happened in 2011 when the temp regs came out, and then certainly in 2013 when the final regs came out, the National Federation of Retailers got together and said, hey, we're brick and mortar stores. This is really confusing for us, and we need some guidelines. And we'd like to work with you, the service, to develop some industry guidelines that will help us conform. And they did that over several years. The restaurant group jumped on board. But basically what it is, in an overly simplified stated way, is that they can take an immediate deduction of 75% of qualified amounts spent to refresh certain property. Then, of course, they're required to capitalize the balance of the 25%. Now, retailers refresh their stores for many reasons. Oftentimes, it's for marketing purposes, or just to they've got a lot of traffic, foot traffic, and they're trying to keep the space nice. So, are they really improving the space? Well, most would argue that they're not. So that's how they came to this decision. Just because, and I want to point out the fact that just because they spent $1 million doesn't mean immediately you can, deduct $750,000. I have qualified amounts in quotation there because you have to first deduct many things, and I think it's somewhere around 16 different items prior to then applying that 75-25 split. So I sit in Columbus, Ohio. We have many large international clothing retailers that are headquartered out of here, and through my discussions with them, this is proving to be a little bit cumbersome, not as simple as they may have originally thought it was going to be. So as you're doing that calculation, I just want you to be aware that that's out there. Another thing to note here on the retail restaurant safe harbor is that this is for large multi-state franchises. We're not talking about the mom and pop shop that has 2 grocery stores or 3 grocery stores. We're talking about the Walmarts and the Targets of the world. There are a couple of things that are specifically excluded. Automotive dealerships, all those, that are listed there, just I guess need better lobbyists. But and then of course for the restaurants, there's hotels, motels, country clubs. They were all excluded. I did a white paper. You can see that at the very bottom of my slide here, and it just basically talks about, it's an 8-page white paper on, I think, about 50 pages of released rules that kind of walk you through how to apply this safe harbor. The IRS also recently just released the ATG related to the capitalization of tangible property. The reason I put this up there, and that was, when I say recent, back in the fall, but what we assume by this is that we had about 222 pages of final regs that came out in 2013. They've been working on it for, they say since 2001, but essentially with the ATG coming out, what we now have is an understanding of they're probably gearing up for audits. So obviously the stand-down order now at this point has been lifted. We don't have audit history, extensive audit history yet, but when this came out, we certainly closed the door and made sure that our work products were aligning with the ATG. Glad to say that they did, but again, all the audits over the next several years will give us a little bit more information on what the intent was in some cases. So the reason we're all here today, and so we'll dive in, is to discuss the tangible property regulations, commonly referred to as the repair regs. What we're trying to determine is whether capital expense is repair or it needs to be capitalized. So my big qualifier right out of the gate is the determination is highly factual. I thought the service did a wonderful job in their efforts to release this. They put, I think, somewhere in the neighborhood of 110 examples, specific examples in the 222 pages of regs that kind of give the taxpayer an understanding of, conceptually, this is what we're stating needs to occur, but practically speaking, this is how you should apply it. So again, if you read all 110 of those examples, you get a pretty good understanding of a practical application. It should be noted, and we'll talk about unit of property quite a lot here, but you must analyze each cost in the context of the unit of property. So I have a very, and again, oversimplistic example here, $30,000 of cost for 5 new plumbing fixtures, where the unit of property is the plumbing system in a rather small 5,000 square foot building. I'll say that this is likely a repair. Now, $30,000 for a cost of the same 5 new plumbing fixtures, where the unit of property, again, is still the same, the plumbing system, but now we're in a 5,000 square foot building. This is likely a repair. And again, it's only that we're determining that the smaller the unit of property, the more likely you're going to get to a capital position, because the more likely you have impacted that unit of property greatly. Now, everybody always asks for the silver bullet answer. Hey, what's the threshold? Just give me that bright line test. Is it over 50%? Is it over 30%? And they didn't provide that. The service didn't provide that. But going back to all of those examples, I'm going to get to right around between 30 and 40%. That's usually where their threshold lies. That's not stated, but again, that's just something, if you go through each one of the examples, something that you can, you'll find out that that's typically about their threshold. So if I impacted the unit of property at 50%, therefore, oftentimes going to have to capitalize that. So what is an improvement? An improvement is defined as an amount paid after the property was originally placed into service, for which it is a betterment to the unit of property, adapts the unit of property to a new or different use, or restores the unit of property, commonly referred to in the industry as the bar test. So we'll spend quite a bit of time on betterment. Anytime you do a refresh or repairs and maintenance to a building, you're trying to make it better, right? Well, that's, just because you painted the wall and you believe it's better doesn't mean that you fail the bar test and you're forced to capitalize. Adaptation, we're going to spend, maybe a minute or two on that. Honestly, it is what it says. If you adapt the space to a new or different use, if it was a car dealership and now it's an office, all the costs associated with that expense is going to need to be capitalized. And then finally, we'll work our way through the restoration component of this, and I think that's probably the most difficult, so we'll spend quite a bit of time there. So you'll hear me talk about failing the bar test or passing the bar test, and this is really what we're talking about, whether or not we need to capitalize or whether or not we can go ahead and expense that amount. So what is the unit of property? It's a functional interdependence test. So all of the components that are functionally interdependent comprise a single unit of property. So for buildings, it was defined for us, so it's a little bit easier. But it's like large manufacturers, and they're making widgets, and they've got several components that help them make that widget. And sometimes, to oversimplify it, we talk about baking cookies. What are the components that are functionally interdependent to bake those cookies or make those cookies? And you've got a blender maybe, and then you've got an oven, and then of course you're packaging it. So are all those components functionally interdependent? On the surface, it would seem so, but are there breaks in the process? Well, of course, you could maybe we're just mixing cookie dough and putting it in ice cream or something. We don't necessarily have to bake the cookie, and we don't have to wrap the cookie either. So on the surface, maybe it seems that they're functionally interdependent, therefore comprising one single unit of property, but if you really dig in, you may find that actually they're all separate units of property. Again, the larger the unit of property, of course, then the smaller, or the more likely it is you're going to get to an expense. So just a quick example, I walked onto a Midwest chemical manufacturing plant, and they had about $2.5 billion of assets. And when I walked onto the plant floor, somebody incredibly smart was walking me around, and their response was, well, it's all functionally interdependent. We're taking, it's just a chemical process through all of these tubes and pipes and barrels, and we're essentially just doing one thing. We're purifying one thing. And his response was right from where he was standing, but that's ultimately not how the service would define it. So, are there breaks in the process? Can you stop the process and hold back, some material? Can you shortcut the process? And oftentimes the answers to those questions are yes, and therefore, it's not $2.5 billion of one unit of property, because if it was, the replacement of $1 million valve would simply be an expense all the time. But it actually had to be broken up into separate units of property for different functions. So anyway, if you have clients that are saying, oh, it's just, it's all functionally interdependent, you may want to stop and say, well, is it really? And kind of dig in a little bit. There's special rules that apply. Plant property, network assets, Network assets, what we're talking about here is electrical and maybe gas distribution. For gas distribution, is it from pump house to pump house? Those actually have some special rules, and it'll help you define that. But I think what we're going to talk about most today is buildings. So I'll kind of in my next slide move to that. But also leasehold improvements. What is the unit of property for leasehold improvements? Well, it depends on whether you're the lessor or the leasee. So we'll talk about that a little at length too. Buildings, unit of property. It was defined for us. This is new. We've never had this previously. But the building structure consists of the building and its structural components and other structural components designated as building systems. And so I'll tell you that there are 8 building systems, and you'll tell me, well, there are 9 bullet points here. Well, what I mean is there are 8 building systems plus everything else. So, HVAC, plumbing system, electrical systems, those are all defined as building systems, and the bar test must be assessed at the building system level. The unit of property is the building itself, but then, of course, the building systems are what we need to take the bar test up against. For leased buildings, the lessor, the entire building is the unit of property. So for multi-tenant buildings, the unit of property is always the entire building. What we're talking about is the Westfield malls of the world. This CBRE, they can assess and evaluate whether they have impacted the unit of property with their repair at the building level, using the entire building and all of the building systems within it. The lessee is a little different. The unit of property is the portion of the building, the volume of space in which they lease. So this is the Abercrombie & Fitch within the Westfield Mall, or the Hallmark store within the mall. So for multi-tenant buildings, the unit of property is just their space, not, hey, well, we replaced the HVAC system, Abercrombie & Fitch did in the mall, and that's just a small component of the overall entire building's HVAC system. Nope, that's not what they're allowing you to do. The unit of property at the leasee level is just the rented space. So for example, a leasee in a large building remodels a bathroom in their office. The expenditure is likely a capital improvement because the work was done on a major portion of the plumbing system of just their office. Let's assume that they just have one restroom in that office, and therefore they're going to have to capitalize that expenditure. However, if a lessor performed the same work, it might be a repair because work only affected a small amount of the building's entire square footage. Now we're talking about maybe a 10-story building with offices on each floor. Well, we did, as the landlord, just a remodel of one bathroom on one floor. Well, there are multiple bathrooms on the other floor, therefore we're going to get to an expense or a repair expense treatment. Additional rules for unit of property. So the depreciation consistency rule, a component is treated as a separate unit of property if it's depreciating at a separate class of property. So for example, if you're doing a cost segregation and that company is going to define assets as personal property recovered over 5, 7, or 15 years, those are separate units of property. And I'll do it for example here. My slide deck does a lot of examples, and that's just really following along with how the tangible property regs were written. A cost segregation study on a hotel segregates electrical systems into categories of 5, 15, and 39-year lives. The 5-year property includes decorative chandeliers and wall sconces. This is personal property. Future expenditures to replace the decorative lighting are compared only to the 5-year lighting cost, not all of the lighting in the building. So, In the future, as you know, this hotel does renovations. The hotels obviously they have a lot of foot traffic, so they do quite a bit of repair and maintenance and upkeep. So if they're replacing those chandeliers or wall sconces, they then have to assess it at that unit of property level, opposed to, well, we have about $600,000 of electrical in the building itself, and we only spent $20,000 of cost to replace those chandeliers, so therefore I'm going to write it off. Nope, that's not allowed. What they're saying is if you've defined it as a separate class of property, that is your new unit of property. Obviously, cost segregations should summarize the buildings at the unit of property level. Pretty much everyone in the industry is caught up there, but you know, that's certainly going to help into the future, where if you do have a cost seg done on a newly constructed building, you go back, you know, 5 years down the road to that cost seg and say, hey, you know, we just replaced the HVAC system, and it cost us $30,000, but the cost seg completed 5 years ago tells me that there's $500,000 of cost associated with the HVAC. So now, just in a real quick check, I get the understanding of, okay, I probably didn't impact the unit of property as greatly as I thought. Now, the $30,000 to replace whatever unit you replaced seems high, so you shouldn't automatically say, yep, that's a high cost, so I'm going to depreciate it rather than expensing it. What I'm saying is, you know, you certainly have to assess at the unit of property level, and a cost seg will help you do that. Okay, so digging into the bar test, this is the front end of the bar test, the Betterment test. So it corrects a material condition or defect, is a material addition, enlargement, expansion, extension of the building, and is a material material increases the capacity, productivity, efficiency, strength, quality, or output. That's the one that people struggle with the most. First, let's say that the word material was not defined by the IRS. So what is material when we're increasing the capacity? So if I'm pumping out 100 widgets a minute and I do something that now I'm pumping out 120 widgets a minute, is that a material increase? So there's certainly an area of controversy, and that's certainly a gray area that people are going to have to navigate. Always, and again, this goes back to my comments previously, is always when you're doing something that you believe to be enhancing maybe the customer experience because you're renovating your target, you're trying to make it better. Well, how much better do you have to make it to force you to capitalize that cost? And we'll talk about some guardrails. Again, there are no bright line tests, but we'll talk about some guardrails that you can use to make sure that you're trying to assess it correctly. One major note, just an enhancement due to technological advances doesn't necessarily constitute a betterment. So when we go out into the market, say if my HVAC system in my office building goes down, I replaced it. Well, the HVAC system that I'm replacing it with is certainly more efficient. You can't go out into the market and buy the old dinosaur anymore. So, that's of course going to be more efficient. Does that then force me, have I corrected a material, have I increased the capacity or the efficiency? Well, yes, I have, but that's just the technology of today. I'm still trying to replace it like for like. I'm not turning my office into a refrigerator. So obviously if it did that, then that would certainly be a capital improvement. But if I go into the market and try to replace like for like, even though it's more efficient, doesn't mean that I necessarily have to capitalize it. There's some specific examples around that. Replacing asphalt shingles with new solar shingles. Yeah, that's probably a capital improvement. But what about replacing wood shingles with asphalt shingles? No, I'd say that's probably just the technology of the day. Here are a couple of examples. Asbestos removal is not a betterment. That's clearly defined in the regs. So a lot of these examples come directly from the examples put forth within the tangible property regs. So that's nothing you have to debate over. It's clearly stated. So at the time of purchasing an assisted living facility, a taxpayer knows it needs work. Right after the purchase, for a period of about 2 years while operating the facility, so it's open, taxpayer pays for extensive repairs to bring the facility back to a higher quality condition. Now, they're bringing it back to a higher quality condition. So right there, people start to think, oh, it's certainly a betterment. Well, it is a betterment, but more so because it's ameliorating an existing condition. The assisted living owner, facility owner, probably paid a discount for a property in which was maybe even dilapidated, was not to code, or certainly knew that needed work. So the service is not going to allow, hey, you paid for a discount, or you bought the building at a discount because you knew it needed all this work, and then you did the work, and I'm going to allow you to expense that. No. We should be forced to capitalize that expenditure to bring it back to what they believe to be probably a normal operating condition. Reconfiguring office space to add more cubicles and spend $30,000 to add 50 more outlets and video data jacks. This is likely a betterment, and the reason is I'm adding something that wasn't previously there. I'm not replacing maybe a analog phone data jack with Cat 5 or Cat 6 cabling. I'm adding something that was previously not there. So anytime you're doing that, it's not a like-for-like replacement. It's something completely new, and you're going to have to capitalize that cost. Not a betterment, and we kind of already talked about this one, replacing wood shingles that are no longer available with comparable asphalt shingles. I'll throw in slate shingles as well. If we're replacing, what we're attempting to do is replace like for like, even though technological advances are there, doesn't necessarily force us to capitalize that cost. So in that scenario, that's not a betterment. It passes the bar test, and therefore I can expense it. Something that is a betterment is replacing the same shingles with lightweight composite shingles that are maintenance-free and a 50-year warranty and a Class A fire rating, and I don't know, makes your coffee for you in the morning as well. Clearly, that is a betterment. You're going from something that is just a normal asphalt shingle to something that would not pass the betterment test. Adaptation, as advertised, certainly don't have much to say here other than if you adapt something to another different use, it needs to be capitalized. That the cost associated with that needs to be capitalized. An example being a manufacturing building turns part of it into a showroom for its business. They replace some walls, paint some walls, some lighting, minor stuff, right? That otherwise we would probably look at and say, hey, that just seems like a simple repair and maintenance, and I'm going to go ahead and expense that. Well, even though it seems to be costs associated with simple repair and maintenance, because it's in conjunction with the adaptation, forces you to capitalize it. We see a lot of this. I've seen this several times. Is that a mattress manufacturer? What they're doing is just building the mattress, and they figured out, well, geez, it costs a lot to ship, and why don't I just take about half of my space and turn that into a showroom, and I'll allow people to come direct to the manufacturer and get a huge discount for their mattress. Well, costs associated with adapting that manufacturing space into showroom space needs to be capitalized under the adaptation rules. Restoration will spend most of the rest of the time on this, is that restoration, only if it's a replacement of a major component or substantial structural part, returns the unit of property to its ordinary operating condition after a state of disrepair, and or if it's no longer functional. And these are words coming directly from the regs here. It rebuilds the property, the unit of property, to a like new condition after the end of its class life. And the class life is defined as the ADS class life. So just be aware of that. Replaces the component, deduct as a loss or adjusted basis taken into account for a gain or a loss. So again, the restoration rules that you really want to focus on is the replacement of a major component or substantial structural part. So again, we have the unit of property, then we have the building itself, or the building system itself for buildings, and then of that system, what are the major components or substantial structural parts? So now we've got kind of three tiers, that we know of buildings, and we'll go through how your decision is impacted based on the restoration rules. So major component, parts that perform a discrete and critical function for the building system, or of course the unit of property. So lighting, air conditioning, flooring, water heater, etc. A substantial structural part is a large physical portion of that building system or the unit of property. So we've replaced more than 50% of the lighting. That's a substantial structural part. Of course, you got to consider all the facts and circumstances, both quantitative and qualitative. So oftentimes I hear from CPAs, well, I have a pretty large cost, so clearly I'm going to have to capitalize it. And there's no other assessment other than, geez, it seems like a large cost. Not just the cost. We've got to look at, the size of the component, what type of component it was, what's the function of that component, how does it work with other components within the building or within the building system. Simply don't just look at, oh, well, it's a big cost, so I have to capitalize it. And that's oftentimes what happens. You've got potentially a controller that's making these decisions that otherwise don't have this kind of background to understand, and they just err on the conservative side. And there's no fault to that, but if they knew a little bit more about the tangible property regs, oftentimes they might get to more of an expense position, certainly helping the company to drive deductions. The replacement of, and this is defined in the regs, the replacement of an incidental component of a unit of property does not constitute a major component, even though it affects the function of the unit of property. So what I'm talking about is, an example of thermostat. It clearly affects the function of the HVAC system, but it's relatively small, it's relatively inexpensive, it is the brains of the operation, but it is not, if you're replacing, everybody's going to the new Nest system that they can control from, they control their HVAC in their house from their phone on a beach in Hawaii. That just because you replaced that simple component that is the brains of the operation doesn't necessarily force you to capitalize that upgrade. So a couple of examples. These were taken, again, directly from the regs, but X owns a retail store and discovers a leak in the roof. X replaces 60% of the roof decking, insulation, and roof membrane. And I'm going to say that this is a restoration, it's an improvement, and it fails the bar test, forcing you to capitalize that cost. Now, that was a little bit of kind of a tricky question in that they replaced roof decking. So roof decking is a structural component, and anytime you're impacting a structural component of the building itself, you're going to end up at a capital improvement. We do a lot of work in California and the seismic requirements are forcing some building owners to do some upgrades, and it's some strapping that's required, and it's relatively small cost, but it's impacting the structural components of the building, and therefore, just because it's a small cost or what you believe to be insignificant doesn't mean that it doesn't need to be capitalized. Another example here, Y owns a factory building with a roof comprised of course structural elements, insulation, and a waterproof membrane. However, Y replaces only the roof membrane with a comparable, I use the word like for like, new membrane. So this is not a betterment, it's a like for like. The roof membrane is a minor portion of the overall roofing system itself. It is not a restoration, it is not a betterment, and of course it passes the bar test, and therefore I'm going to take that as a current year expense and treat it as a repair. So I oftentimes get maybe frantic phone calls from a CPA that says, John, we replaced the roof. Is that a repair or a capital improvement? And immediately I don't really have all of the details to make an intelligent decision on this. What did they? So I go into a series of questions. What was the total scope of work? I rarely even ask what the cost was. It's not relevant. Did they replace just the rubber membrane? Yeah, that's what they did. Okay, then clearly, it's a clear example in the regs that that is a current year expense. So, as you're reaching out to individuals with questions, have the details. Oftentimes, there's a scope of work listed on the AIA or payment application or invoice that you get from the vendor itself. So have those details ready and available. Here's just a couple of pictures that show examples. We talked about the roof repairs. Parking lot maintenance, that's one that comes up quite a bit. Maybe think about Westfield Mall. We'll go back to them. They've got some pretty big parking lots out there, and they oftentimes are made of asphalt, which is requiring maintenance every now and again, and oftentimes that comes in the way of slurry coat seals. So they just basically, it's kind of like hot mop, put some new tar down, fills all the cracks, and prolongs the life of the actual asset itself. Now, again, that's another question I get. Hey, we did a new parking lot. The cost was $200,000. Well, if it's a huge parking lot like the Westfield Mall, that still could be repairs and maintenance. It could simply be a slurry coat seal, which is simply like painting and therefore a current year expense. So it's kind of like the telephone game when you were kids. You all sat around the circle, and somebody started off with one thing in mind, and they passed it ear to ear. What happens is the maintenance director says, hey, we did a slurry coat seal on the parking lot, and the controller heard they have a new parking lot, and so the director of tax said, oh, new parking lot, great, we've got to go ahead and capitalize that. Well, there certainly was a disconnect in understanding what the scope of work was, and that leads to bad decisions sometimes, and oftentimes really it leads to probably overly conservative treatment and capitalizing things opposed to taking them as a current year expense. Still in the restoration here, restoration standards must be applied to all major components of the building or unit of property. So first, they must identify what is the major component of the building system, and then see if it's a significant portion that was replaced. And I, like many other colleagues of mine, will use the HVAC example. This is a favorite example that's taken right from the regs. So an office building has an HVAC system, which is comprised of 3 furnaces, 3 AC units, and of course some ducting to help this conditioned air navigate through the building itself. One furnace breaks down, and it was replaced with a new furnace, a like-for-like new furnace. Now, 3 furnaces together perform a critical function, which is, heating the building itself. So the 3 furnaces all together comprise of one major component. However, just replacing one, or 33% of that major component, is not a significant portion of the major component. It's not a restoration. It passes the bar test, and of course, then I'll tell you, is a current year expense. So again, the question always comes. You're getting the question, as CPAs from your client. Hey, we replaced the AC unit. Is that I heard that could be an expense. Maybe it's a capital improvement. I'm not sure. Well, you simply don't have the answers or all the details to provide the answer. So you go into a series of questions, and understanding what the major component of the building system is should be within your line of question. More examples. The office building with one HVAC system. It's comprised of 1 chiller, 1 boiler, and a cooling tower. The chiller is replaced with a comparable unit, like for like, right? The chiller functions to cool the water to generate the HVAC and cool the building itself. The chiller, however, performs a discrete and critical function for the HVAC system, so therefore you're going to have to capitalize it. So again, in the second bullet point, I'm pointing out, it's just a comparable unit, like for like. So I'm going to try to expense that? Nope, not necessarily. You've impacted greatly, and quite frankly, wholly in this case. The chiller itself, or the major component of the HVAC system, and so therefore you're forced to capitalize that. Assume the same scenario as above, but now we have 4 chillers and we replaced only 1. Now, yeah, I'm going to tell you that absolutely 25% of the major component was impacted, and therefore you can take that as a current year expense. Again, more examples, and this is probably a little bit more real example that we see from our clients is an office space has an HVAC system with 10 rooftop units. They're referred to in the industry as RTUs. And what this does is cool different areas of the space. Controls allow for distribution of heat and AC through various spaces of the building. The building experiences climate control problems in various offices. So the owner replaced only 3, or 30% of the 10 units. The 10 units together are the major component of the HVAC system, so just replacing 3 of them is not a significant portion of the major component, is not a substantial structural part, therefore passes the bar test, and we're going to take it as a current year expense. Now, I talked about the ATG that was released on September 14th. There is some inconsistencies with how they define, with examples within the regs and the ATG. In the regs themselves, we understand that regardless of whether it's, let's say, servicing the 10 units are servicing wings A, B, and C, we have to always assess it at the major component level, regardless of whether it's an A, B, or C. It's the building itself. If it's one building, is the unit of property. In the ATG, they said that you probably do need to assess it. At each different space level, buildings A, B, and C, or I guess they're not separate buildings, they're just different components of that building or wings of that building. So it's still playing out. I just wanted to highlight that. There are some slight inconsistencies with the ATG and what we saw within the final regs. Some practical tips for you here. We, just the same as you probably might receive a client phone call and they say, well, I replaced an HVAC system. Is that a current year expense? And first of all, the quick thing that I'll do is ask them in what building. Give me the address of the building, and I'll get on Google Earth. It's some pretty neat software that allows me to zero into things pretty detailed. And they'll say, well, we just replaced one. And I'll tell them, well, it appears that you have 5 units on the roof just by doing that. I can even highlight those and use that as my supporting documentation. The invoice clearly says that I replaced one. It could be for $200,000. It doesn't matter. I replaced one of 5. Therefore, it's I didn't impact the major component, which is all of the HVAC rooftop units combined together, and therefore I'm going to go ahead and expense it. That's simply quite. That could be my paper trail to how I got to my decision. The photo on the right, oftentimes, if it's not on the roof, maybe we'll use street view. Sometimes we're allowed to, we can see certain aspects of certain buildings. So if you have a client that calls you trying to understand, how do I get to the correct decision here, again, just knowing that you need to assess it at the unit of property / major component level for restorations, you can use these tricks. You can't talk about the tangible property regs, of course, without discussing the retirements and dispositions that were released about almost a full year later. So the new rules say that you can take a deduction loss when you remove anything from your building. An example, if you pay $50,000 for new lighting in your building and you need to capitalize it, you're forced to capitalize it because you didn't pass the bar test, and you capitalize that amount over 39 years, you can now calculate the value of the old lights and take an immediate deduction on any remaining basis. We're actually seeing quite a bit of that. There are quite a number of companies out there that are going around the country talking to large space buildings. So this is, your 300,000 square foot manufacturing building, or potentially, a office building with 100,000 square feet, and saying, hey, look, I can replace all of your lighting for, let's come up with the number, $1 million. And but over 4 years, you're going to save, $1 million in your energy cost. Even in our homes these days, we're using light bulbs that are using 1/10 the power, right? So they do this return on investment calculation, and then they also say, oh, by the way, you can also take an immediate deduction for all of that old lighting that we've ripped out. And we've been involved in a couple of those calculations as well. Partial disposition election now needs to be made timely on the tax return, including extensions for the portion of property that was disposed of. So you basically have to, the service gave an opportunity for everybody to go back and do late partial dispositions. That opportunity is now closed. So if you're doing partial dispositions, you need to do it in the year the asset was disposed. So just understand that there was the service when these dropped said, hey, look, this is a new rule. We're going to allow you to go back and clean things up. But now, obviously, that window has been shut. And if you're making dispositions, you need to do them timely. The retirement of structural components. So an example here, a taxpayer acquired a $5 million building in 2009. In 2015, they spent about $1 million to remodel a portion of the second floor. Simple ceilings, walls, lighting, plumbing, ducting, some electrical work. A retirement study determines that the original cost basis of the demolished assets, the removed assets, is $470,000. of course, of and out of the $5 million that was spent in 2009. So they can now recognize a loss of $404,000 in the current year. So basically, I took the original cost basis less, of course, any depreciation already taken to come up with the $404,000 number. But that's pretty significant, where otherwise you would have just kept it on the books and continued to depreciate it. The reason it's significant is because it's creating permanent tax savings. And I'll go into the example here. So if you incorrectly continue to depreciate 1245 and 1250 property that was removed from the building itself, you're going to pay recapture on the sale. Now, I say incorrectly continue to depreciate. Yeah, technically, you should be taking your allowable dispositions, but we don't see that the service is going to come running in and saying, haha, you missed a bunch of deductions and we're going to disallow future deductions. The rules are clear that they potentially could do that, but certainly it goes back to intent of what the law itself, and we just simply don't think that that's going to be the case. So if you continue to depreciate items that are in the landfill, you're not getting that immediate deduction, but we think those deductions will stay. So in this example, 1245 property is recaptured at ordinary rates, and 1250 property, or long life property, or structural components of the building are recaptured at 25%. And capital gains rates taxed at 20%. So partial dispositions of a building component for normal repair is not a Section 1231 loss. And if I go into the next slide, I can show you the calculation and kind of why it's powerful, why you need to be assessing your fixed asset roll forward. If you see a significant spend, you may ask the question, okay, what did you remove? And if it's nothing, great. If it's, oh, we totally gutted the building, well, we probably want to take a look at what portion of that building was gutted and what is the value of that, and then remove it from the books in the current year. So in the previous example, $5 million, a $5 million building with $470,000 of retirements. If we continue to depreciate it, they recapture all of it upon the sale. So let's say $370,000 of that was for long life property, but $100,000 was for personal property or 1245 property. So the recapture tax is $127,000. So what I did was $370,000 against 25% or 25%, and then the $100,000 at the ordinary rate of 35%. However, if they did a retirement study, the recapture on the $470,000 is zero. So actually, you're just going to pay, the capital gains tax. It's $94,000 opposed to the $127,500, which is permanent tax savings of a little over $30,000 upon the sale. That's pretty powerful stuff. And if your clients have a building that they maybe are refreshing and they're looking forward to, in a couple of years, potentially sell it, you want to make sure that you've taken a look at any allowable dispositions or retirements that may be out there. Okay, so removal cost and demolition. So if you're, have a $5 million building and you do some demo to it to then improve it in some way or reconfigure it in some way, the demolition cost, the old rule was that the removal cost of an asset component needed to be capitalized with the new component. However, the new rule is such that the removal cost of an asset component can be deducted if the taxpayer, and only if the taxpayer recognizes a gain or loss on the old component for tax. So this goes back to what we just talked about, which is, if I'm certainly capitalizing the new cost of the fit out, but I've taken allowable disposition for the items that I have removed, the cost to remove those items can also be deducted. For example, a landlord owns a 3-unit commercial building and pays $200,000 for the improvements in each of the spaces in year 1. In year 5, one of the 3 tenants leaves, and the new tenant requires the landlord to gut and renovate the space, costing a total now in year 5 of $340,000. The contractor's detail and scope clearly defines that $40,000 was related to demolition, and that's just the cost to remove the old components. So now the landlord can expense the $40,000 of demolition costs, and they must also deduct the remaining portion of the $200,000 which was placed into service in the first year. Again, it was gut renovated, so that's all now been removed. So you can take the allowable disposition on the $200,000, but also you can take an immediate deduction for the $40,000 worth of demolition. That's new. Obviously, you had to take the demolition and attribute it to the new cost. It was an allocable indirect to the new components going in, and that's now different. Determining the basis of a removed building component, that's oftentimes the biggest hurdle that we experience with our clients, in that what they say is, that's great. I know that I removed walls and flooring and ceilings and lighting from the space, but I have no idea how much that cost. Now, here are a couple of tricks in an effort to come up with those values. You of course can use a cost segregation study. We kind of talked about that. If everything's being defined and laid out at the unit of property level, that cost seg should have some pretty good detail on, how much lighting was in that building, and what were the partitional walls. If I removed all the partitional walls in the interior of the building, the cost seg should clearly identify that. You can discount the cost of a replacement component to its placed in service date using a PPI calculator, and we do have, at the very bottom I highlight this, a tool online within our KBKG solution site that allows you to type some things in and come up with a value for that removed component. Can be used for restorations, but PPI calculator can't be used for betterments or adaptations. This is going to sound pretty simple, but oftentimes, unfortunately, overlooked. The replacement of an old standard roof with a more expensive solar roof, which is reflective and, like I said before, makes your coffee for you in the morning. You can't discount the cost of that new roof, that new solar roof, and take an allowable disposition for the old roof. It's not like for like. It's not comparable. You're apples and oranges at that point. And of course, adaptation. So replacing an HVAC system in an old office to convert it into a restaurant can't be discounted, because the restaurant's HVAC is going to be, the spend and the cost for a restaurant HVAC is going to be significantly higher. We've got exhaust fans and makeup air units. And of course, human thermal comfort that are impacted. That cost is going to be greater for that space opposed to just the office space. So we'll go through a couple of examples and just kind of a note of caution here for the discounting method. It's useful, but it can certainly, in a couple of my earlier examples, can grossly overstate the retirement loss if the building component was replaced within the 10-year period. So it doesn't account for condition of the building when it was purchased. So, for example, I've got a discounting method, but I'm discounting a new asset. When I purchased the building, maybe that asset was already 20 years old, and it wasn't a new asset when I bought it. So therefore, it was physically depreciated, and therefore the condition factor or the value attributed to it should also be lower for tax purposes. So examples here, the building acquired 3 years ago, an owner spent $200,000 to replace aluminum windows in this year. Discounting windows for 3 years with the PPI calculator states that the removed windows are $186,000. So we're just taking the $200,000, discounting it back 3 years, and I get $186,000. However, this resembles or represents the value of brand new windows. And like we talked about, the windows had 3 years life left. So an appropriate condition factor need to be applied. So my disposition is in $186,000 actually after applying that condition factor of 27%, I get to a value that's much, much less, $50,000. So again, just a word of caution, you need to apply a condition factor. It's pretty simple stuff, but oftentimes overlooked, and certainly you don't want to be in a position where you've overstated your disposition, your allowable disposition. Plan of rehabilitation is obsolete. So the old rule said that if you did repairs to a building that's a bigger part of a rehab, you had to capitalize it. And this kind of goes back to one of the questions that was asked earlier. The new rule says repair and maintenance cost not incurred by reason of improvement can be expensed as long as the repair work had nothing to do with the other improvements. So we're kind of splitting hairs, but the example I think does a nice job of helping us understand it. So example one is B spends $500,000 to rewire a building for new lights. Because of the electrical work, there was also $30,000 of cost to cut the drywall, patch, and paint areas that were rewired. So you have to capitalize all $530,000, and that's because the patching and painting was caused by reason of the improvement. So they're directly related. Example two is basically flipping example one on its head and saying that they spent, again, $500,000 to rewire the building and upgrade the electrical system. But at the same time, it just made sense that they're going to spend $30,000 to patch and paint areas of the building that were unrelated to the electrical improvements. Maybe they did a shutdown. Oftentimes, heavy manufacturers do shutdown in the summer. It just makes sense to do all the repairs at once. Some relate to one another and some don't. So in this scenario, in example B or example 2, $30,000 can be expensed because it was unrelated to the improvement. It was not caused by reason of the improvement. So again, just understand oftentimes if you have got one contractor or multiple contractors in there, what you end up with is the GL that says, hey, we spent $500,000. And your question should be, and we love the detail, is on what? Well, we did a bunch of rewire work, and that totals $500,000. But if you look at the detail, there was also somebody in there power washing, the front of the building. Oh yeah, we did that because we're probably going to repaint the front of the building. Well, that's not caused by reason of, so therefore the power washing is an expense, and the balance of the $500,000 potentially needs to be capitalized. Tax planning under the new rules. This is I'll say is a small opportunity. It is. I wouldn't expect anybody to run out and find a ton of these, but it's worth mentioning. So a taxpayer spent $3 million on renovations in 2010, and KBKG performed cost segregation, leaving $2.5 million left in 39-year category. So KBKG reviewed the construction docs. The work that was done was they reshingled and replaced the roof, replaced some acoustical ceiling tiles, drop ceiling on a small portion of the building, asphalt paving. All they did was patching and resealing, and they just replaced 2 of the 20 rooftop units. So based on the new rules, and of course it was strategic that we put it, cost side was performed in 2010 because the temp regs came out in 2011, is that based on the new rules, $350,000 should be repair deductions. Now, we can recognize an additional $328,000 on the return by filing a 3115, because, of course, that's the $350,000 less any depreciation already taken. That's creating a permanent tax savings of $17,500 upon the sale. So, again, that's pretty significant. And if you had a cost seg done, probably prior to 2011, certainly prior to 2013, you might want to take a look at it, because potentially, that company that did that didn't identify repairs and maintenance because we didn't have the tangible property regs yet, and they just included it all within the capitalized basis. Again, that's a potential opportunity. Some types like to, I think they say, let the sleeping dog lie. So if it's significant, it may be something to look at, but not. And the further we get away from the tax year 2011 and that kind of thing, we see less and less of those opportunities. Okay, so also in the tangible property regs, we had some rules around routine maintenance safe harbor. So you can expense costs related if you reasonably expect at the time of placing it in service to perform this service more than once during its class life. And again, that's defined as the ADS class life. So you must reasonably expect to perform it more than once during a 10-year period for buildings. So it's not the ADS class life. There was a separate statement in the rules that defined that if you're relating it to a building, not maybe a process, then that ADS class life is defined as 10 years. So, for example, every 5 years, the escalator handrails were replaced in the building. Okay, so we reasonably, at the time of placing it in service, expected to do it more than once in a 10-year period, and therefore, under the routine maintenance safe harbor, I can expense it. I had an opportunity to walk through. It was in southern Indiana. They brought in flat steel and made bushings. So they rolled it. There were several processes that went through, but if you can imagine, it was pretty heavy industry. And I was on the plant floor and talking to a gentleman who'd been there, I don't know, 35 years, and I said, looking at one piece of equipment, said, how often do you perform what was significant spend? How often do you perform that routine maintenance safe or routine maintenance? And he said, well, I can reasonably expect to do it every 3 years. And I said, great. How often have you done it? And he said, well, I haven't done it in 12 years, which wasn't going to be more than twice in the ADS life. And I said, that doesn't make any sense. You're telling me that you can expect to do it in every 3 years, but you haven't done it in 12. So there's a disconnect here. And it was kind of one of those moments where he's like, listen, Sonny, he pulled out what was the manufacturer's book that clearly defined when they should be doing maintenance on this piece of equipment. And he said, I haven't done it in 12 years, but this book right here from the manufacturer tells me that I should be doing it every 3. And that shut me up real quick. And he was certainly right that, and he had no idea about the tax law, but he was certainly right in that if and when he performs that routine maintenance safe harbor, he can take it as a current year deduction because he reasonably expects to do it more than once over its ADS class life. It can fail the safe harbor and still be considered an expense. So, like for example, every 12 years we replaced an HVAC unit. Well, that's not more than once in a 10-year period for buildings, but it may, as we looked at the bar test, the Betterment and restoration rules, still qualify as a current year expense because it didn't impact the major component of the HVAC system greatly. We replaced one of 10 units. So just because you fail the routine maintenance safe harbor doesn't necessarily say that you can't take it as an expense. In my line of work, I walk many different factory floors, and I love it because I kind of get an opportunity to peek behind the curtain of many different types of businesses and how those businesses are using their fixed assets. This is an example. Fortunately or unfortunately, I was in Alabama in July, walking through this plant, and that is a furnace that is there are actually 3 furnaces that look just like that, and it was really hot. They were in shutdown though, and they were replacing at a significant cost the brick lining of that furnace that you see on the left, the brick being on the right. Now, under the routine maintenance safe harbor, I had asked the individual, how often do you do this? And we have a shutdown every year in July, and we do one of the furnaces every year. So we have 3 furnaces, and therefore, we can reasonably expect to have to replace this at a significant cost every 3 years. And that was the only proof that I needed to support that as an expense in the routine maintenance safe harbor. But just kind of an interesting set of facts that led us to that treatment of what I think was somewhere over $750,000 worth of cost related to just that brick reline. Safe harbor for small taxpayers. You can elect to expense amounts of $10,000 or 2% of adjusted basis of the building. So it's actually small taxpayers if they have less than $10 million of annual average annual revenue over the last 3 years. They're defined as a small taxpayer. Eligible building for unadjusted basis of $1 million or less, so on and so forth. Another tax planning idea might be that in an effort to define yourself as such, maybe you had a cost seg done and that reduced the real property basis enough to make you eligible for the election. The example being, you had $1.3 million worth of 39-year property, but after the cost seg, the cost seg engineer was able to, come up with $400,000 worth of accelerated depreciation or 5-year, 15-year personal property that then gets you under the threshold of what's required on the unadjusted basis of $1 million or less for a building. De minimis expensing. I see some red highlights there. There's some updates. So you might have been thinking of one thing and then didn't know of the change. But a taxpayer with applicable financial statements, these are big taxpayers that would have a $5,000 expensing threshold per item or per invoice. So they must have a written policy in place stating that that is their threshold or whatever their threshold is. And then they must treat the amounts as an expense for book as well. So it's not a cherry pick kind of thing. You know, if you're taking the de minimis safe harbor, you've got to do it for both. So it should be stated that $5,000 is the threshold, but you can have even if you're a large taxpayer, a threshold that's lower than that. I'm a tax person, so I think with that cap on, but oftentimes, I have individuals at large corporations that say, hey, look, the tail shouldn't wag the dog here. I get what you're trying to say, that it could be up to and $5,000, but it doesn't have to be that. It impacts our financial statements greatly if it is that high, and therefore we're simply not going to do it. And that's absolutely understandable and a correct answer for that individual taxpayer. Taxpayers without audited financial statements or applicable financial statements, the threshold was $500. Strike that. Now it's $2,500. So when the service came out with this in 2013, there was a lot of commentary that said, hey, look, that's a real small number, even for small taxpayers. We need that to be increased. So that was increased for 2016 and beyond for $2,500. They don't need to have a written policy in place. There was a lot of that going on in 2014, end of 13 time frame. Everybody was even on the back of a napkin, dating it and saying, hey, our de minimis threshold is X. Now, the safe harbor protects you up to $5,000 or $2,500. Some taxpayers are huge and quite simply say, look, we've talked to our we're under continuous audit and we've chosen $10,000, which is fine. You can make that threshold whatever you want, but the safe harbor will protect you just from $5,000 for a large taxpayer below. The things that might be at risk are the items that you've expensed from $5,000 to $10,000, say if that was your expensing limit. I've highlighted per item or invoice here. You can't split cost among multiple invoices. So there's some anti-abuse rules that state that don't buy a $20,000 truck and say, hey, go ahead and invoice me 5 times for that. That'd be great. Therefore, each invoice is under $5,000, and I'm just going to expense that. No. Not allowed. But per item, even if you have an invoice that is $10,000, but it's clearly stating that it is for a number of different items that just total over $5,000, but each individual item on that invoice is below the threshold, you certainly can take that as an expense under the de minimis safe harbor rules. So again, it's per item, per invoice, so just make sure that you check the invoices to make sure that it's clearly defined. I bought X number of chairs. The total was over $5,000, but I bought 50 of them, and so them individually meet the threshold. Just defining applicable financial statements. So if you have a 10K, you're a large taxpayer. Should be pretty self-explanatory, but one thing that might not be certified audited financial statements accompanied by a report of an independent CPA that's used for, of course, reporting to the shareholders, credit purposes, that kind of thing. So, and of course, anything financials that are required to be provided for any state or federal agency. This can help you be defined as a large taxpayer, following the large taxpayer rules, and clearly stating that you have applicable financial statements. Materials and supplies. So I think potentially on the population of this phone call wouldn't deal a ton with this, but it's worth noting. It is defined as tangible property used in the taxpayer's business that's not inventory. So these are consumables within the process. So yeah, fuel, lubricants, water, that kind of stuff. Items with that don't have a useful life of more than a year. Anything under $200, that was $100 in the temp regs, and they bumped it to $200. Materials and supplies are defined as both incidental and non-incidental. So incidental is no records of consumption kept or physical inventories. These are deducted when paid. So the non-incidentals there are records of consumption and inventories kept, and those need to be deducted when used or consumed. It's a timing thing, but if you're dealing with a lot of materials and supplies, which maybe some heavy manufacturers are, they should at least understand these rules and try to put policies in place to adhere to these rules. I kind of had an interesting opportunity. This is now 2 years ago, but I was at a distribution company, and that distribution company had tires, a whole mess full of them, and there was actually an auditing agent there. This is before the stand-down order, and they said, well, they were treating those as materials and supplies, consumables, and they're putting a lot of miles on these tires in just a couple of short months, and so the tax director said to the agent's question, do you know how many tires that you have out there? And the tax director said, oh, absolutely not. Nope, just a whole pile of them out there. We don't know. And we walked onto the floor and asked the individual that was in charge of the inventory cage. That should have been your first clue. But they said, do you have any clue how many tires are in that pile over there? He says, about 176. And he says, wow, how do you know that? And he says, well, I need to know how many I have on hand, so I need to replace those. So my point being is that oftentimes, the toilet papers and the pencils and that kind of stuff, we don't have physical inventories kept, but you'd be surprised at how often there are physical inventories kept for, just very minor things like gloves or that kind of thing. And you don't want to get yourself into a scenario where you're just flat wrong, and they are tracking these things, even though they're minor, they're tracking those things, and so then there certainly should be deducted when used or consumed, not immediately when paid. Materials and supplies, I had that $200 threshold there. Taxpayer was unable to take de minimis safe harbor for waste receptacles since it would cause a material misstatement in GAAP. But it could treat them as materials and supplies, immediately deducting them, since there was no book to tax conformity rules. The waste receptacles picture there on the right, that was a significant spend for this refuse company. These toters were in the ballpark of, I think, around $180, and so they went ahead and expensed that, and that was a pretty favorable decision for them. Also, we had a beer manufacturing company that have, kegs and pony kegs. I think the pony kegs were right around the ballpark of $130 and then $155 for the large ones. But they were underneath the threshold of $200, and certainly were able to take them as an immediate deduction of the materials supplies rules. Again, both of for beer manufacturer, you've got a lot of kegs, so that added up pretty quickly. So that was great in both instances. 2016 method changes. So these are just some of the common change of accounting methods that we're completing. Of course, change number 7 has been around forever. I won't say forever, for a long time. But they basically, when we're doing a cost segregation look-back study, this is the catch-up and adjustment for changing recovery periods from one thing to another. Dispositions of a building or structural components for separately stated assets, such as tenant improvements or roofs. These are individual assets listed on the depreciation schedule. That's asset or change method 205. Just kind of scooting through here. Late partial dispositions, as previously noted, that opportunity is now sunsetted. That was change 196. You can do partial dispositions still, but they need to be made timely. So don't fool yourself in that you're going to do late partial dispositions. The service gave everyone an opportunity to clean things up, maybe take multiple roofs off the depreciation schedule, and now that opportunity's gone. Of course, repairs, that's change number 184. This is going from we previously capitalized it, and now under the new rules, we understand we can take it as a current year expense. So less any depreciation already taken is your 481A calculation. It's pretty simple to do that, but yeah, if you're identifying repairs, we oftentimes will refer to these as fixed asset reviews, or some people refer to them as fixed asset scrubs. It's basically taking your entire fixed asset export and or your depreciation schedule export and just reviewing it to make sure that what's listed there are truly depreciable items and not potentially a repair. So how can KBKG help? That's a comprehensive fixed asset review is something we've done quite a number of over the last several years, particularly since the regs have dropped. This is basically just taking a holistic viewpoint of the tax recovery periods and or repairs and maintenance or potentially dispositions, instead of just that targeted, hey, there's $1 million building here on the depreciation schedule, there might be a cost seg. Yeah, there may be a cost seg within the comprehensive fixed asset review, but it's oftentimes much more fruitful if you take a holistic approach to having the fixed asset schedule cleaned up. Also, it's worth mentioning on the KBKG's Solutions website that there's some software that allows certain clients that maybe you're real good at completing the 3115 forms. It's just not the catch-up and adjustment or the calculation. The 481A calculation is the difficult part. There's some software on our Solutions dashboard that allow you to complete that pretty painlessly. We talked about it before, partial dispositions calculator, and some other stuff. This is what that dashboard looks like. This is my homepage, or actually one of my colleagues' homepage, the viewpoint, and so you can get into that software and perform the task, or potentially there's some videos on tutorials on what this software will help you do. I love those. It is always a good refresher course for me, even to understand in those yellow buttons there, radio buttons, that hey, look, this is how I can do the 481A calculator. Watch that video, and then of course gain access to the software itself and use it. Again, thanks for hanging in there with me today.